Welcome to this Academy introduction to futures contracts. We'll be looking at what a futures contract is, its main benefits, and how it can be used in your trading. A futures contract allows you to trade a wide range of markets, including stock indices, agricultural products, oil and energies, base metals, precious metals, bonds, short-term interest rates, meats, soft commodities, and Forex on live market prices. In finance, a futures contract is a standardised contract between two parties. It's an agreement to exchange a specified asset of standardised quantity and quality for a price agreed today, the futures price, with delivery occurring at a specified future date, the delivery date. The contracts are traded on a futures exchange. The party agreeing to buy the underlying asset in the future, the buyer of the contract, is said to be long, and the party agreeing to sell the asset in the future, the seller of the contract, is said to be short. The terminology reflects the expectations of the parties. The buyer hopes or expects that the price of the underlying asset, and therefore the futures contract, is going to increase, while the seller hopes or expects that it will decrease. In many cases, the underlying asset to a futures contract may not be a traditional commodity at all. For financial futures, the underlying asset could be a currency, a security, an intangible asset, or a referenced item, such as a stock index or interest rate. While the futures contract specifies a trade taking place in the future, the purpose of the futures exchange institution is to act as intermediary and to minimise the risk of default by either party. To minimise credit risk to the exchange, traders must post a margin or a performance bond, which is typically 5 to 15% of the contract's value. To minimise counterparty risk to traders, trades executed on regulated exchanges are guaranteed by a clearinghouse. Now, there are two types of margin. The first is the initial margin, which initiates a futures position, and the second, the maintenance margin, which maintains the position. Futures contracts ensure their liquidity by being highly standardised. There are a number of different elements to standardisation. Firstly, the underlying asset or instrument will be clearly specified in the futures contract. This could be anything from a barrel of crude oil to a short-term interest rate. The contract will also state the type of settlement, which will either be cash or physical delivery, and the amount and units of the underlying asset per contract. For example, this could be the notional amount of bonds, a fixed number of barrels of oil, units of foreign currency, or the notional amount of the deposit over which the short-term interest rate is traded. Furthermore, the futures contract will confirm the currency in which the contract is quoted. It will also specify the grade of the deliverable. In the case of physical commodities, the contract will specify not only the quality of the underlying goods, but also the manner and location of delivery. For example, the NYMEX light sweet crude oil contract would specify the acceptable sulfur content, and the American Petroleum Institute would specify the gravity of the oil, as well as the pricing point, which is the location where delivery must be made. Finally, the futures contract will also specify the delivery month, the last trading date, the commodity tick, which is the minimum amount by which a commodity can fluctuate, and the maximum permissible price fluctuation. Since you're a trader, you probably don't want to take physical delivery of the underlying asset on expiry of a futures contract. So it's a good idea to take note of the expiry and first notice dates of any futures contracts in which you have positions and ensure that they are closed before the appropriate day, as described later. The first notice is the day after, when an investor who's purchased a futures contract may be required to take physical delivery of the contract's underlying commodity. If the first notice date is before the expiry date, then the position needs to be closed the day before the first notice date. If the expiry date is before the first notice date, then the position needs to be closed no later than on the expiry date. The primary purpose of the futures market is to allow those who wish to manage price risk, the hedgers, to transfer that risk to those who are willing to take that risk, the speculators, in return for an opportunity to profit. There are two principal advantages to trading futures contracts. Leverage is a measure of the worth or value of an investment relative to the money required to buy or sell the investment. For example, if you need to pay the full value of an asset when you buy it, then there is no leverage. On the other hand, if you only need to put up a small fraction of the value of an asset in order to buy it, then leverage is high. Futures are highly leveraged assets, since you only need to put a proportion of the money down, referred to as margin. Speculators, or in other words traders, take on the price risk that hedgers try to avoid in return for a possibility of profits. They have no commercial interest in the underlying commodities and are motivated purely by the potential for profit. Speculators play an important role in the futures market. Without them bridging the gap between buyers and sellers with a commercial interest, the market would be less fluid, less efficient and more volatile. Futures speculators take a long futures position when they believe that the price of the underlying asset will rise. They take a short futures position when they believe that the price of the underlying asset will fall. Producers, manufacturers and portfolio managers can make use of the futures market to hedge the price risk of commodities that they need to purchase or sell in order to protect their profit margins. Businesses employ a long hedge to lock in the price of a raw material that they wish to buy sometime in the future. To lock in a selling price for a product that they wish to sell in the future, a short hedge is used. Let's suppose that an investor believes that in September the Euro Stoxx 50 index is going to rise by 10% within the next few months. Instead of buying the 50 stocks that compose the Euro Stoxx 50 index, he'll buy a Euro Stoxx 50 futures contract that expires in December. The level of the index is 3,200 and the investor wants to invest the equivalent of 100,000 euros in the trade. He calculates the number of contracts to be bought as follows. He divides the sum to invest, which is 100,000 euros, by the level of the index, multiplied by the tick value, which is 3,200 times 10 euros. The result is 3.12, which means he can buy 3 futures contracts. So the investor buys 3 Euro Stoxx 50 futures contracts that are set to expire in December at the current index level, which is 3,200. But instead of paying the full value per contract, the future value multiplied by the tick value, which is 3,200 times 10 euros, amounting to 32,000 euros, he will only be required to deposit an initial margin of 2,271 euros, or 7.09% of the nominal value per contract. If the market rises 10% to 3,520, he will make a profit of 9,600 euros. The calculation for this is 3,520 minus 3,200 times 10 euros times 3 contracts, which equals 9,600 euros. Although the Euro Stoxx 50 index has only moved by 10% in our example, the return on investment is 140.91%. This leverage is made possible by the relatively low margin, approximately 7%, that the investor needed to put up in order to control the full value of the index. On the other hand, if the market was down 10%, the investor would have lost €9,600.